South Korea and Texas Instruments. Both of them got slammed this past week for what they reported. South Korea reported another quarter of worse than lackluster GDP, while Texas Instruments, kind of the same area, technology and auto industry, which is what's plaguing South Korea. Texas Instruments got slammed in its stock for reporting that the bottom everyone has been looking for in those industries didn't happen and didn't materialize in the fourth quarter. So starting with South Korea reported its third straight basically flat to lower reading in GDP, which means South Korea's GDP is starting to look a lot like Germany's. It doesn't look like a recession that most people recognize as a recession, but like Germany's, sideways is a contraction. And if you do it more than a couple quarters in a row, it becomes an enormous contraction. While South Korea isn't there yet, everyone was expecting GDP to rebound in the fourth quarter instead of being flat yet again. So we have another example and another global bellwether in these key critical industries like technology and automobiles, suggesting tremendous weakness. And because it's South Korea, and because South Korea is a bellwether, this is not just about the political turmoil in South Korea, nor the struggles in the South Korean economy. This is a lot about China, its lack of response to the bazooka. This is about trade with the rest of the world. This is about the global economy. Texas Instruments, the same thing. The tech business has been in for a rough ride for the last couple of years, basically the same couple of years that the economy forgot how to grow and stopped growing. And everyone has been looking for a bottom in the inventory cycle, demand to pick up, wholesalers to clear out their inventories. And while many people were thinking, okay, the end of 2024, the start of 2025, that's going to be the recovery period, Texas Instrument, what they just reported, same thing as South Korea, got more dark clouds still on the horizon. So, Steve, Mr. Van Meter, South Korea, Texas Instruments, seems like very different things, but really they're the same thing coming at it from different angles. Auto business, technology, and it goes on from there, right?
Yeah, absolutely, Jeff, because what we've seen is the global economy slow down a bit and then it kind of hits a little plateau and everyone gets excited, says, hey, this is it. Like, it's not going to get any worse. Things are going to get better. We're going to be plateauing for a little bit, but don't worry. And then all of a sudden, oh, we take another leg down. And then we plateau again. And everyone's like, okay, can't get worse from here. But we continue to see it is getting worse. Consumers around the world, they're stuck dealing with inflation. Prices are rising. Wages aren't rising as fast to keep up with it. We're seeing more people hit the unemployment line, not big numbers, but just steadily people are losing their job. And what's the problem with that? We continue to hear from workers. They say, I can't find another job. I'm on unemployment longer. And that starts to spread. People start to hear about it. Hey, my friend's been unemployed for 3 months. Gosh, things are slowing down where I'm at. That means I have to cut spending. And that's what we're seeing from Texas Instruments. That's what we're seeing in South Korea. It's all because consumer demand is going down.
Yeah, it's not just the US consumer demand, right, Steve? This is a global phenomenon. That's what we keep coming back to. And a lot of people, they look at the data and they say, well, it doesn't look that bad, right? I mean, Germany's GDP hasn't crashed by any stretch of the imagination, but it's been sideways, like perfectly sideways for more than 2 years, which it doesn't immediately seem like that's a big problem. When it is, sideways is a contraction. If it isn't growing, then it is shrinking. And that's absolutely the case. When people are conditioned to believe if it isn't crashing, then it must be okay. So that's the one thing that I think is really hard for a lot to understand is that, if it isn't crashing, there's a whole bunch of bad in between. The fact that South Korean GDP isn't crashing here, but it is sideways, that's ringing an alarm bell, especially since South Korean GDP, like a lot of places around the world, you can see that South Korea never recovered from the pandemic. It never got back onto trend, which is what a recovery literally means. So already being short of a full recovery, then all of a sudden this weak spot hits in 2024 when, as you just said, Steve, things are supposed to be turning around and moving the other direction. So South Korea hits a weak spot in 2024, and it just adds another really serious alarm to all these others that are piling up that whatever the expectations from either central banks and rate cuts or maybe better policies in the United States or any number of, China's bazooka, South Korea is saying very clearly, nope, we're not seeing any benefit from any of those things. If anything, we're seeing everything move in the wrong direction. Again, key critical industries, cyclical industries, therefore cyclical indications.
You're exactly right, Jeff, because what did we hear going into the election was it was all about the election, that everybody was just waiting to
And
find
what was
out
it?
who.
Election uncertainty. What was the term everybody used, right, Steve? We saw it everywhere. Election uncertainty.
Yeah, it was the excuse. But as soon as we know, as soon as the election's over, man, just wait. U.S. consumers are going to spend and spend big. But you're right. It comes back to the China bazooka. There's really nothing that happened from it. And you look at the post pandemic, all the stimulus gone. You're seeing boomers in waves, which is right around their retirement age, anyways. They're retiring. And when you take all these people out of the workforce, their spending declines, and yet people are surprised. Why are these restaurants, in middle cities, big cities, are closing down? Because, well, one, people aren't going to work as much, but two, without the boomers commuting, automobile industry is going down because a lot of boomers had about 2.5 cars. Well, when you retire, you start to realize that, hey, that's a lot of extra expenses, and maybe we don't drive it much. And next thing you know, 2.5 becomes 1.5 down to one, and maybe depending on where you live, a golf cart. But all of a sudden, you're seeing this huge lack of demand due to no pandemic stimulus and due to the fact you're seeing this huge wave of boomers around the world retire. And it's all about feeding into the economy. The economy's got to go down to get to wherever the actual level of demand is. I just don't think we're there yet. And that's what South Korea and Texas Instruments is saying too, is like, we thought we were there, but well, maybe not.
Yeah, you hit the nail right on the head. It's that we had this idea that everything was booming in 2021. And so we need to slow down to where the fundamental equilibrium is. And everybody thought that slow down, that's what Jay Powell says. That's what Christine Lagarde said. That's what the head of the Bank of Canada, yeah, Bank of Canada, as well as the Bank of Korea, they've all said the same thing. Yeah, it was red hot. It was too hot. It was actually inflationary. And we just need to slow down to something more stable and more long run, less inflationary. What they're finding out and what we're seeing now into 2025 is that this slowdown isn't slowing down. Again, it's not crashing. It doesn't look like a typical recession, but it's a recession nonetheless because it continues to slow down way past everyone's expectations because it has to. What you just said, Steve, is exactly right. We have to match the activity in the economy with the ability of the economy to support that activity. So that means incomes, actual levels of activities. I think if retired people could find out a way to use half a car, they probably would do that, which would further the problems here. So the economy is searching for its long run potential, and that long run potential is not a recovery. It's not robust. It's a lot less than, first of all, what people are expecting, but it's a lot less than what the entire world really needs to continue to grow and sustainably grow on a long run basis. That's really the issue here, is that it's searching for, every time you think it's found the bottom, it seems to find another one beyond it. And that's really the process here.
Yeah, Jeff, and the stimulus from China, that was supposed to get us to some sort of equilibrium. And you and I said it's not going to do anything. And sure enough, it didn't. But how about some rate cuts? Well, that's all we need, man. Just a few rate cuts because it'll bring the economy right into equilibrium. I mean, you could look around the economy and say, did the rate cuts do anything for anyone? Well, you can make the case they didn't because all we got was a plateau. We didn't get a real change in the economy other than we got sentiment increases. People said, yeah, things are going to get better. We saw some new order growth show up in the U.S. manufacturing sector in November, only to get massively reversed in December when shoppers went to the store for the holiday season and found out, hey, I still can't afford these higher prices. And of course, that's all backflowing massively in a big way to companies like Texas Instruments, who, as you said, relies on the automobile industry that people aren't spending. But look at Germany, right? What did baby boomers like to drive when they went to work? As they're late in their career, making lots of money, they like to drive nice luxury vehicles. Well, all of a sudden, what's happening with BMW and Mercedes plunging, Volkswagen can't sell cars to help themselves. I mean, all of a sudden, this vortex of demand is just impacting major sectors all around the world. And like you said, Jeff, all we see is sideways GDP. That is until it goes down.
Yeah. So yeah, that's one of the things about South Korea, and both South Korea and Texas Instrument, is that if there was going to be some positive from rate cuts, that's right where we see it. Because first of all, the auto industry, as you know, Steve, the auto industry it should be highly interest rate sensitive. So if the auto industry was struggling, you think, okay, that's high rates, then that's the problem. Then if the rates start to come down, that would fix the problem. But what South Korea said is, we're still struggling with our auto exports. And Texas Instrument, I want to read a summation of Texas Instruments earnings report here just to drive this point home. They said the same thing. We're struggling in tech as well as industry and autos, which if interest rate cuts were going to be the positive thing that the economy needed to start to grow again, we're not seeing it in these two critical places. Let me read the summary here. Texas Instruments gets the biggest portion of its sales from manufacturers of industrial equipment and vehicles, making its projections a bellwether for much of the global economy. 3 months ago, executives said some of the company's end markets were showing signs of emerging from an inventory glut, but the rebound hasn't come as quickly as some investors anticipated. In reality, the rebound didn't actually show up at all. And according to CEO Haviv Ilan, industrial demand remains slow. Industrial automation and energy infrastructure still haven't found the bottom. And in the automotive segment, growth in China, there's the bazooka, just wasn't as strong as it has been, meaning that any growth in China or strength in China is no longer able to offset weakness in the other parts of the world. So the one place where China was actually doing well, Texas Instrument now says it's no longer doing well. And now we can't depend upon it doing well to make up for all the other stuff that we expected to be doing well that actually isn't doing well. And again, this is Texas Instrument. This is South Korea. We're talking about critical cyclical industries, global bellwethers for the entire system.
Yeah, Jeff, and it's all right back to the consumers. If people were out buying cars because there were rate cuts or they needed cars, which they don't, then Texas Instruments would be saying, hey, we're seeing a turnaround, and that's why it's so critical. I mean, what did we hear from Apple? And I know they don't report their earnings till next week, but what are we hearing already signs from is demand for iPhones is going down. Now that backfeeds to chip manufacturers as well. But what are they saying? Consumers aren't finding value in AI and the need to upgrade. Or you could simply translate it as consumers would find value in it if they had the money to upgrade, because people always need an extra camera on their phone or an extra button or something a little bit faster. But now they're saying, hey, look, I don't need AI, but more importantly, I can't afford AI. And that's what we're hearing from Texas Instruments that says, hey, we see this as an inventory issue. The problem is demand didn't go up after the inventory got drawn down. They don't need as much stuff. We're not at the bottom. And again, it's all back to South Korea, all back to major exporters. We're seeing this all around the world.
Yeah, I think it's almost as if consumers can't afford AI phones. They're going to have to go back to the fax machine, right, Steve? They can't use anything. They don't have the ability to use anything. They have to use the cheapest tech that they possibly can.
Fax machine stocks, Jeff, they're going to boom here. My prediction on this show. Remember this.
Exactly. But in all seriousness, that's what South Korea said. Part of their struggle here is the AI bubble itself, so the AI boom. South Korea was one of the major beneficiaries. A lot of investment went into South Korea because it is one of the key semiconductor spots in the entire world, the other being Taiwan. So South Korea benefited tremendously from the AI infrastructure boom. And now people are saying in South Korea, maybe we got to hold up on some of our investments because we're not sure any of them are going to pay off. And the reason they're not going to pay off is, number one, does the AI technology match the hype? And there's all sorts of problems about that. And number two, what you just said, can people actually afford the stuff that actually is worth the hype? And if it is worth the hype, it's going to be incredibly expensive. And these days, expensive, that's not on any consumer's radar. They're all trading down to the cheaper stuff. They're trading down to the fax machine because they can't afford anything else. And so that eventually backfills into everything, including South Korea's economy, Texas Instruments reports and its earnings and its revenues, and everything else that goes along with it. The entire global economy is struggling to find its stable equilibrium and continues to find that it's even lower than we thought last quarter.
Yeah, and that's a big fear, because if it keeps going lower, you need fewer and fewer workers, and that's a big issue.
It becomes like self-feeding, right? Because then you expect a bottom, so you hold on to your workers. Then you find out there was no bottom, and it's like, okay, now I got to get rid of more workers, and then just on and on we go.
Right. Or we see in some case here in the U.S., companies did hire, and then they realize like, oh, well, there's cost cutting, which means even the people that got hired know they're not likely to keep their job very long. And of course, you put yourself in that situation. You're at work, your job's, business is slowing down. You can clearly see it. You know your friends have been out of work. They can't find a job. What's that going to do to your spending? Are you going to go out and buy that new iPhone or that big upgrade? Of course you're not going to do it, even if you wanted AI, because the reality is if you lose your job, you know you're not going to get another one. At least the probabilities that you're going to be on unemployment for an extended period of time are high. So what happens? You start saving money. You start paying down your debt. You start preparing for the inevitable. And then you get, kind of that self-licking ice cream cone effect where all of a sudden lack of demand leads more layoffs, leads to more lack of demand, more layoffs, and it spirals downward.
Yeah, and I think that's one of the reasons that we have that. First of all, that trend, it continues to be in place, is because we can't find a bottom, because we're coming off an artificial high. And oddly enough, that's the one thing that everyone agrees on. We were at an artificial high. What we just don't know is, where's the bottom? Where does it actually start to find itself and then move into the other direction? Central bankers and economists, and up until recently politicians, they were optimistic that there wasn't that big of a transition from the artificial high to a more sustainable growth path, where, as we're talking about here, and all the data continues to show, even though it's not crashing, what it does show conclusively is this process of finding the bottom is still ongoing. Even though we're now almost 3 years into this process, we still haven't found the bottom yet. We're still searching for the bottom. And even if it doesn't look like a recession, in South Korea, like Germany, or the United States, we see with the US labor market data, we never had the recovery to begin with, and now we're getting into a position where it actually does get worse, even if it isn't crashing right away.
Yeah, Jeff. And one thing we've been talking about is that, yes, you can get stimulus and there will likely be stimulus in the future as global economies slow down. But we've warned, if you overuse stimulus, future stimulus doesn't work. What did we see in China? Didn't do anything. How about rate cuts? Again, everyone said, oh, all we need is a couple rate cuts. We said, it's not going to move the needle at all. Sure enough, it didn't. I mean, we could lower rates to zero. I don't think that would change anything right now. I think there's something much bigger going on. And again, like you said, where is the bottom here? Where is the bottom in demand? A lot of companies keep saying this is it because they don't want to face the reality is, I don't want to lay these people off, because that's the next step. And I think we're far closer to it than a lot of people realize.
Yeah, the answer is that rate cuts are not the solution here. Even if you thought that rate hikes were the reason for this slowdown to begin with, rate cuts are proving to not be the answer to it. And that's what's really important about South Korea and Texas Instrument, because of the industries that they're focused on, and both of them reporting basically the same thing at the same time. We haven't found a bottom. There is no impact from rate cuts. It's not about interest rates here. It's something more profound and more fundamental.